This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris, and you're listening to News Radio 93.1 WFLA. Here on Dollars and Cents, we're Central Florida's longest-running radio program, and we like to talk about anything and everything that has anything to do with your dollars, helping you make sense out of all of those different items, ranging from retirement to your mortgage to your investments to Social Security. We'll talk a little bit about that today as well, and the latest of the headlines. So the headlines of yesterday were about the news from Friday that the jobless rate had hit a 50-year low. Unemployment rate in this country at 3.6% has not been that low in over 50 years. That's really amazing. I think certainly there's stronger hiring out there. I mean, I think businesses are continuing to staff up, but there's also a decrease in the number of laborers out there as you get more of the baby boom generation retiring. Then that means that there's less folks out there in the workforce, or less folks out who want to be out there in the workforce. Although I am happy to report that the workforce did, in fact, add one more person this past week when my eldest son, Nelson, who turned 18 in March, got himself a job for the summer before he goes off to Auburn University. He's working at the car wash. So he becomes part of the labor workforce. I didn't have the heart to tell him that, he's going to be part of that gig for the next 50 years, but I figured I'd leave that one alone. But certainly the unemployment rate at 3.6% is really a pretty remarkable rate. We actually got an email yesterday from Chris, who actually had some interesting comments on the current unemployment rate at 3.6% versus what the rate was. I guess you have to go back to 1969 in order to find a lower unemployment rate. And Chris actually has some interesting insight that I think is quite accurate. And he emails me, Joel, know you're doing well. Since January, it has been a very good year. That is true. Obviously, low unemployment rates and things like that show a pretty strong economy, which then translates nicely into equity returns. Just a short note that you may want to bring up on your radio show. Today, it was announced that this is the lowest unemployment since 1969. I was around in 1969. I volunteered for the Army. In 1969, you still had a draft, so those people would be working at Uncle Sam's behest via the draft, and another number of people were in college to avoid the draft. So the unemployment rate is actually lower than 1969. So if we take so I think what Chris is saying, the unemployment rate could be the lowest. Could that be, I guess, in theory, the lowest in history? If you back out the fact that in 1969, a lot of them were you were required to be in the workforce via the draft. An interesting comment, Chris, on it. It is fascinating to see how much the labor market is really changing. And that's kind of the interesting thing is, I think there's a lot of folks that have morphed their skill set, if you will, because in order to get that unemployment number down that low, you've got to really have had some adaptation of your skills. Now, the other side of that argument is that with participation in decline, it could be that many of those people that did not have the skills of today simply have left the workforce and never to return. And there may be a part of the argument on that, but certainly that can't be said for everybody. Yet at the same time, there has been a seismic shift and will continue to be a seismic shift in the types of jobs and the types of skills that are necessary out there. As a matter of fact, according to the World Economic Forum, employers in 12 different industries worldwide anticipate that the split between work performed by humans versus work performed by machines will shift over the course of the next 3 years to a completely different number. So this survey looked at industries involving automotive, aviation, energy, financial services, infrastructure, oil and gas, professional services. And what it concluded was that in 2018, 71% of all work was performed by humans, 29% performed by machines. In just 3 years, that number will shift to 58-42. That's a pretty significant shift when you start to think about that in terms of the workforce and labor. And certainly that means that there's a lot of folks out there that are either they've done it or they're going to have to do it in terms of re-evaluating and changing their skill set, if you will. But certainly some interesting numbers when you kind of look at the percentages of what is expected to change over the course of the next 3 years. How much more machines and automation will continue that trend, but yet the backdrop is that you've got low unemployment. So that is a good sign that you're still able to maintain low unemployment in that environment where clearly the types of jobs are shifting. That I guess the positive takeaway that I have from that is that people are working either they're working and have developed new skill sets, or I guess the flip side is that unfortunately they may very well be out of the workforce, which is the negative of, to the extent the unemployment is low, that is sort of the negative of those numbers, is when you look at the labor participation, that part has in fact declined. So markets obviously responded quite positively to that, although for the week they were basically flat because there was a couple of days where the market was down. So for the week, the market was somewhat flat, even with Friday's upward movement. If you look at since Santa came to town, it's actually been a pretty dramatic increase. If you look since Christmas, so there really has been a lot of treats that Santa brought. Because if you look at the performance of the market since Christmas Day, it's up nearly 26%. Pretty dramatic number when you stop and think about that. What's sad about that is that same month, since Santa came to town, that same month of December saw the largest outflow from equity mutual funds in history. So a lot of people left the market right at the point in time when the market started an increase, and that's a relatively short period of time, basically 4 months since Christmas, where it's up nearly 26%. So some pretty dramatic numbers when you stop and think about just how much has changed over the course of the markets over the course of the past 4 months, and what also is going on simultaneously with the economic data. And Chris's point is even more interesting as well, is that 1969, a lot of those people were forced to get into the workforce at Uncle Sam's behest. This time around, there's not that force at play, but yet the unemployment number continues to be at a historically low number. So good economic news all the way around on that. We'll take a break. When we get back from the break, we'll shift some gears. We'll talk a little bit about Social Security, and we will also open up the lines, not just the phone lines, but also the email lines, although that line on email is always open, right? So the email is Joel at NelsonFinancialPlanning.com. That's the email that you can reach out to us on. And then you can also call us, 407-916-5400, toll-free 866-916-5400. We'll talk to you later.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give them a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Also simulcasting over there to our friends on the AM dial at 540 AM. On the program, we spent a little bit of time in that first segment kind of recapping the current headlines and economic data. That's certainly a pretty impressive jobless rate, standing at 3.6%. Pretty strong stuff coming out of the economy, even though, as a lot of people say, the economic cycle has been going on for a while. The reality is that economic cycles don't die of old age. People do. And if the economic conditions are still present, and certainly they are, with low unemployment and low inflation and low interest rates, then you can certainly see the economy and then correspondingly the markets continuing to move forward. Certainly since Christmas, since Santa came to town, it's been a pretty remarkable move in the overall markets, up nearly 26% since Christmas Day. And you thought you only got the presents that were under the tree. This is another present, certainly for your investment portfolio, that's for sure. Anyway, open lines 407-916-5400, toll free 1-866-916-5400, and then the email is Joel at NelsonFinancialPlanning.com. So hearing a lot these days about everybody talking about Social Security optimization and how you figure out what's the most amount of money that you can collect from Social Security. And I want to take a little bit of time on the program and kind of debunk what all that mystery is all about, because we've got the software in the office as well, and we've certainly played around with it. And at the end of the day, okay, the way you collect the most amount of money from Social Security when you run all of these optimization calculators is that you wait as long as possible, okay, and then you live as long as possible. And what's fascinating about these programs and these optimization calculators that you hear about and these fancy reports that you can get is that's what it tells you. Well, you don't need a 20-page report to tell you that if I wait as long as possible, well, then of course I'm going to get my maximum amount of Social Security. It's not going to be subject to a reduction because I took it early. And then if I wait all the way to age 70, it then increases an additional 8% on top of that. So clearly the maximum amount that I can collect from Social Security is going to be when I am at age 70. And then if I live till 95, and I'm being serious because that's what these computer programs will run it out to, or maybe 90, 95, whatever. You get the point. well, then sure, that those dollars are going to add to more than what I would have gotten at, starting at 62. The problem is this. The problem is they sort of ignore a couple of different things. Number one, most importantly, most people don't live till 90 or 95. Might be something to think about. And number two, they also don't take into account the time value of money, which simply means money today is worth more than money 20 years from now. That's just the eroding power of inflation. That's why, from an investment perspective, you always have to be doing at least as good as of inflation. Good news is that inflation of late has been relatively low. In fact, over the course of the past 15 years, the last 20 years, 25 years, the inflation rate has been hovering around 2.2, whereby in the 50 years before that, inflation was hovering at about 4.3. So inflation has been relatively tame over the course of the past 25 years, but don't get falsely comfortable with that. I think there's a lot of reasons why we've seen that rate be a little bit more on the lighter side. A lot of it is kind of post 2008 and the incredibly low interest rates and the freely available money that was available out there, which kept inflation in check. I also think, and we were talking a little bit about this actually with some friends last night, I also don't think that inflation truly takes into account the game that is happening at the grocery store. And I don't know if you've noticed this or not, but when you buy a gallon of ice cream, it's not a gallon of ice cream. When you buy a box of pasta, it's no longer a pound of pasta. It's less. What used to be a 16-ounce box of pasta is now only 12 ounce. Check it out. It's something that you wouldn't have seen or wouldn't have noticed, and certainly they don't. But I think that's kind of one of those other things that's kind of happening out there that's holding inflation in check a little bit in terms of the numbers. But certainly inflation's been relatively low. I don't know that we can certainly bank on that for the next 25 years. So you've got the power of and the effect of inflation in there. And then third, and most importantly, when you start talking about this Social Security optimization, and the studies are real that conclude that retirees, in fact, need more income in the first 10, 15 years of retirement than they do in the last 10 or 15. Now, why do you suppose that is? Well, in the first 10 or 15 years of retirement, you're 10 or 15 years younger than you are when you're in the last 10 or 15 years of retirement. And when you're younger, you're able to do more stuff. And when you do more stuff, usually doing stuff takes money. And so very clearly, if you've ever seen the studies, they do it like as a little chart, and it really, the first few years of retirement, that's your peak expense years. That's when you need as much income as you can. The reality is when you're 85 or 90, you're just not doing as much. You don't have as big a need for income as you did, even with all of those expected healthcare expenses that cook into those numbers as you age. You still wind up with a much higher expense level when you are in early retirement. So some important things to be thinking about when folks talk about Social Security and Social Security optimization and let me run a report and here's 20 pages. Every one of them concludes the same silly thing, which is that if you wait as long as possible and live as long as possible, well, then you'll have the most amount of money. Okay, tell me something that I can use. Well, here's some factors to be thinking about. Number one, okay, when do you need the money? Number two, what's really your life expectancy? Number three, what's the effect of inflation in the analysis? Now, don't get me wrong. I think the analysis on Social Security absolutely has to be done on a case-by-case basis. But I think far too often there's this mentality that's getting pushed out there that says, oh, we'll delay it as long as possible and then you'll have more and that will be good. True, but what's the situation of the particular individual that we're looking at? And to just simply say wait and then collect, I think that really cuts the analysis pretty short. You think you have to ask some questions like, what, are you still working? That becomes a pretty important question. Okay, if you're still working, okay, well then you certainly shouldn't be taking any Social Security early because you're going to have to give it back if you're making over $17,000. And then if you're still working and you're past your full retirement age, what tax bracket are you in? Are you in a pretty high tax bracket? So you're just going to collect Social Security, and then you're going to turn around and pay taxes on it, and you didn't necessarily need that money now? Well, okay, maybe you wait. Now, those are some very specific examples as to good reasons to wait. But if you're fully retired, why are you waiting? Because you got to get that, you have to have that effective income come from somewhere, right? So wouldn't it be better if you took less out of your investments in retirement and relied on Social Security to give you that income? Because then by taking less out of your investments in retirement, those assets then have the ability to be much more sustainable and maybe even to get some additional growth in on top as well. So what that means is that you become in a much more better financial condition over the course of your retirement because you did not take a higher level of income off of your assets at the earliest possible time. You use Social Security to help provide some level of income, which thereupon reduced down how much you had to take out of your assets. That's really the key point is, look, you got to get that income from somewhere, right, when you're retired? So think about where you're getting it from and how to balance that out. Far too often we hear all about these optimization calculators, and the off the hip advice is wait. Our general advice would be the opposite of that. Take it, but run the numbers, do the analysis, and make sure that makes sense for your particular situation. But I think way too often the assumption of I'm just going to delay doesn't really make sense, because all of those calculations that you get, those 20-page reports when you run this, simply ignores those three key components. Time value of money, which is basically inflation, the reality of when you actually need more income because you have more expenses in retirement, and then the reality of life expectancy. Just because you might live till 90 or 95 doesn't mean you're going to. So certainly some things to think about there as it relates to Social Security. We'll slide to the break here at the bottom of half of the hour. We've got open lines at 407-916-5400. Toll free 1-866-916-5400. And then the email is joel@nelsonfinancialplanning.com. Those are the numbers to call on in and be a part of the program here on Dollars and Cents with Joel Garris on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. On the program, we were just chatting a little bit about Social Security and some of the conversations you hear about how to optimize your Social Security. And we've run those programs, and we have those programs at the office, and frankly, we don't bother to really run them because when we study exactly how the information comes, it simply just says, well, if you delay as long as possible and live as long as possible, then congratulations, you'll collect the most. Except that sort of ignores the three key points that we were summarizing before the break, which is very simply inflation. It's there, and it chews away the power of your dollars. Number two, who's to say you're going to live till 90? Life expectancies being what they are, that certainly isn't a guarantee. And number three, and probably more important, for your enjoyment of your retirement, guess what? You need more money in the first few years than you do in the last few years. The last point that I didn't make, but I'll make it this time around. Isn't that plan not on the soundest of financial footing? Don't you think you're going to see Social Security maybe change a little bit? Now, I don't know that if you're close to Social Security age where you would see any changes, but we can't predict that. What we do know is the very simple following fact, that the trust fund's going to run out in the year 2034. It's going to run out in the year 2034. Now, understand, we're not big fans of people making financial decisions based upon fear. Okay? When we have conversations with clients, it's not fear. I don't believe making decisions when based upon being scared into doing something is a wise financial decision. Financial decisions should be made with clarity and not based upon emotions, not fear, not greed. Far too often we hear product pitches in the financial services industry talking about fear and a fear-based approach. What if the market goes down? Oh my goodness, if the market goes down, you really need to be buying my annuity. Whoa, give me a break. But here's the reality with Social Security. In the year 2034, it is projected that the Social Security Trust Fund would be down to zero in the year 2034. The trust fund does not mean the payment of Social Security would stop. What it does mean is that the payment of Social Security could be subject to a potential 23% reduction. That's the numbers that you've got when it relates to Social Security. So when they talk about Social Security going broke, obviously they don't really mean it's going broke, but the trust fund is, in fact, projected to run out of money in the year 2034. Folks, that's only 15 years from now, number one. Number two, that still means, though, that there would be Social Security still getting paid out, but it would be at a reduction of 23%. Let's see how those Social Security optimization calculators work out when there's a 23% drop 15 years from now. I don't think they have that in there. But the reality is that those are the numbers. So if you're going to run an optimization calculator talking about Social Security, well, don't you have to put in the fact that 15 years from now it's set to have that benefit decline by 23%? That would seem to me that your optimization of waiting as long as possible and living as long as possible is kind of a faulty misrepresentation of what might happen. And see, that's the problem. The problem with all computer programs is they're only as good as the input you put in, and they're only as good as the underlying assumptions that are in there. And you can make a computer program give you any result that you want, as long as you set it up that way. And if you're ignoring some vital reality of what actually is projected, of what actually is supposed to happen, then it would seem to me that gets you to a pretty easy conclusion that is the opposite of what many in the financial services industry would lead you to believe. I think the mainstream idea of delay, and take it later is, in fact, a flawed one at best. Everybody's different. There's certainly some scenarios where we'll say to folks, nope, you want to wait. You want to take it later on. There's certainly those scenarios. But for the vast majority, the answer is take it when you can, not wait. None of those calculations, none of those programs take into account the actual projection from Social Security themselves that says that in 15 years they're going to have to slash the benefit by 23%. You want to have a real conversation in Washington about what's important? Yeah, have that conversation. And while you're at it, have the conversation about Medicare too. Because you never hear about that one, but the projected shortfall in Medicare over the same time period is 7 times greater than the projected shortfall in Social Security. When are these folks in Washington going to stop the nonsense and actually focus on solving real problems that we all are going to face if they continue to fiddle while Rome burns? The sooner you come up with an approach, the sooner you adjust the numbers, number one, the more time you give people to plan for a change. And number two, it's not nearly as tough of a solution as when you wait, right? I mean, the longer you wait to solve a problem, the harder it's going to be to solve that problem. And yet they continue to just kind of ignore. And no conversation. There's you got so many people running for president. I mean, there's no real conversation about it. It's all about free college. It's this. It's that. No conversation about what are we going to do to fix the deficit, to fix Social Security, to fix Medicare. Oh, I'm sorry. If somebody were to talk about that, they probably wouldn't get elected. Yeah, that's okay. Yep, that's a problem. But eventually, it's going to be an even bigger problem. And the sooner you figure out some form of a solution, the better off you are. That's the real conversation that needs to be happening up in Washington, not the nonsense that they spend their time on. But anyway, I digress. Got a little political there. Not really political, though, because that's what I'm saying applies to both parties in equal measure. So we'll take a break. When we get back from the break, we'll continue the conversation here on Dollars and Cents. We'll get off the bully pulpit here at News Radio 93.1 WFLA and continue the conversation about other financial stuff when we get back. Open lines, too, 407-916-5400. Toll free, 1-866-916-5400. Curious if anybody's got a take on the Social Security conversation we're having on the program today. And then email joel@nelsonfinancialplanning.com. That's how you can get in touch with us here on the program Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA, simulcasting over there on 540 AM as well. On the program today, we've covered a lot of territory, a little bit of a recap on the economy. Certainly some good numbers coming out, particularly that low employment rate number that has really continues to show continued job strength, although lower labor participation. So that is certainly a factor to look at in terms of the number. And then we've talked a little bit about Social Security, how to optimize trying to debunk some of the standard comments or the standard advice that you would get out there in the world at large. The notion of always taking it early, I think, is false. I think the general assumption should be the flip opposite of that. Everybody's different. Everybody's unique. So it's always good to run the numbers and look at the situation. But the suggestion that these optimization calculators come up with doesn't really actually take into account that Social Security's own projection is that they're going to have to cut the benefit by 23% in 15 years. Well, once you put that into the mix, I'm pretty sure that the analysis is going to say, maybe I should take it now. Anyway, we'll go to the phones. Rick in Orlando, good morning. How are you?
Good morning, Joel. I got a call just yesterday. This number said this Social Security number is being used in illegal activity in the state of Texas, and it said call this number will stop the problem. And actually, it's a scam going around. But I called the real number in Social Security Administration, and I looked up,
Right.
and there's a message you get that says, we're aware there's a big scam going around. They don't want anyone to be hooked and they're giving information to some crook somewhere.
You know what, Rick? Thank you for calling and letting our listeners know that. I actually got that same call yesterday.
Oh, gee, you too.
Yeah, your Social Security number has been compromised, and I almost, I wish I had hit the button. It was running around. It's high school graduation season and all that, so we're running around doing a bunch of stuff, a bunch of parties and all that, and so the call came in at kind of in the afternoon, wasn't really, and so I just kind of ignored it and meant to talk about it. So I'm super glad you called, Rick, because I was going to mention that as well on the program. Is folks, listen up. This is real. Rick got the call. I got the call. Ignore it. Ignore it. Ignore it. Ignore it. I wish I though had the presence of mind to maybe click the button and just see what would have happened just out of curiosity, maybe giving them a made up Social Security number and see what they see what they would have done in response to that. But yeah, so you just hung up on it. You didn't. I didn't. Yeah, that's
they left
the safest
a
bet.
voicemail message on my phone. There's also something else at church this morning. A priest announced that parishioners were getting bogus calls claiming they were soliciting funds for the church. And there was nothing to do with any church that he knows of. It's completely bogus.
Yeah,
Another
that's
one.
Crazy. Yep. The answer
Be
is
real careful.
Folks need to be real careful out there. That's exactly right. That's exactly right. That's a very important topic for our listeners. So thank you, Rick, for calling in and giving us that one.
Thank you, Joe.
All right. Yeah, I mean it's crazy. And then the other one that's very popular at tax time is the IRS is coming to arrest you. They're coming to arrest you, and you need to send in money, and you need to pay. And if you don't, you're going to go to jail and call this number to pay immediately. That's another very popular one. And there's just so many. I mean, the bottom line is that if you didn't originate the transaction or the call or the donation, just ignore it. Just hang up on it. That's the safest thing to do, is just to hang up on it and ignore it. Certainly not call back, because that's when they're going to try and trap you. These are professionals. These are professional criminal organizations in places like Russia and North Korea that are that's what they do. That's all they do. And they're just looking to grab as much money as they can from you. So you've got to be super, super careful. And as an aside, and I mentioned this on a prior radio show, but we're very careful about that in the office because we have certainly at the office gotten emails that are from hacked client emails that say, please wire money, blah, blah, blah. So we have a procedure in place that allows us to double check and back check that. But yeah, it's real. And our staff goes through ongoing training and certification on security and how to watch for fake emails and all those kinds of things. You'd think financial services in business, you just might need some certifications in the financial world. Well, you need one as it relates to computer and computer security and computer technology as well. So we have an ongoing training program in the office that actually tests folks' ability by sending out kind of fake emails to test and see if folks would click on it, and then obviously that yields additional training. So it's an ongoing battle across the board, but we certainly see many people falling victim to those scams, no matter what. So be careful. Words of caution. Rick, thank you so much for that call. I had that on my head to mention it, but then I kind of lost track of it. So yeah, they called me, and it was on my cell phone too. So it used to be that your cell phone number was, not able, not really known out there, and so you didn't get those kinds of calls on your cell phone. But obviously, technology being what they are, it is it's amazing how they're able to track these numbers down and make those calls. So I am sure if Rick and I got the same call yesterday, there was a lot of calls happening out there in Central Florida. So hopefully nobody fell victim to that. If you did, what you need to immediately do is do a fraud alert on your credit. And maybe, depending upon how far down you went with them, you may want to consider a complete freeze as well. The freeze is the tougher level. The fraud alert is a much not quite as dramatic in terms of how much it locks up your credit. But so like if you lose your wallet or something like that, then we usually recommend a fraud alert. In this case, if maybe you actually talked to them and gave them your Social Security number, I would probably go with the freeze, and I'd do that immediately. To do that, you just need to call one of the three credit monitoring agencies, Experian, TransUnion, I forget what the third one is. But those are the best ones to, that's the best way to do that, is to reach out and do a credit freeze if for some reason you found yourself falling victim to these phone calls that were going on, obviously on a regular basis during the course of yesterday. And I had not heard the one about folks calling to donate money to the church, but that doesn't surprise me. They will try anything and everything to be able to do that, and that's particularly a tough because obviously they target folks that are older and may not be as dialed in on what exactly it is that they're trying to do. So some interesting points to really be thinking about as it relates to protecting your identity and protecting yourself from those scammers. So after the radio show today, we will have an interesting event. My oldest, as I mentioned, is graduating from high school, so those festivities really sort of began in full swing this week. So we go off to our baccalaureate service this afternoon. And man, I guess at some point it will start to get real for mom and dad that the oldest is about ready to fly the nest. Hopefully there's no crash landings. But yes, that will start to get pretty real. I can't believe that we are at this stage in life, but hey, that's life, and it speeds along at an ever-increasing pace. So we're looking forward to that. I'm sure that will be a little emotional as it starts to begin to sink in. But hey, that's what life's all about. So we're looking forward to it. Hope you have a good rest of your Sunday as well and a good week ahead. Thank you all for listening to the program. We'll be back next week, as we are each and every week, here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA. Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.